Good morning, traders and investors. Ben at TyndallTradingAnalysis.com. Thank you all so much for tuning in, and happy middle of September Wednesday. What is it, the 15th already? My goodness, this year has gone by way too quickly. Thank you guys for joining us. We do apologize for getting started a little bit late. We're having some technical difficulties in the back end with YouTube. It didn't want to process the video right at the start of the show, but hey, we appreciate you guys sticking around, and thanks for joining us. The markets, I tell you what, have been rather interesting since we last met. When we last talked, we had looked at a completed five-wave rally from the August 18th, August 19th area lows, and looking for a corrective pullback to potentially begin to help identify where we are within that higher degree structure. And you know, I'd say 3 or 4 weeks back when we had met, we had identified a potential major wave one top in the Nasdaq 100. And if you've been following our work at trading analysis through 2021, you'll know that we had a zone in the NDX between 15,500 and 15,700 that was offered from multiple degrees of trend. It was 3, if not 4 degrees of trend, and they were all very typical fib targets. So we had a pretty significant confluence of resistance in that area. And we've been operating under the belief that that zone could in fact shut price action down and result in the larger primary degree wave 2 pullback that's kind of been hanging out off to the right hand side of my charts. And even as we've seen price action reject this zone, the 15.5 to 15.7 level in the NDX, we've yet to see the confirming signals to help suggest that that larger move is here. Now, there are certainly some characteristics about this current pullback that differ from the last 5 pullbacks that does make it a bit concerning. Another aspect of this market correction that is a little bit interesting is last week we had the ruling regarding the Apple or the Epic Games versus Apple lawsuit, but that was a Northern California district judge. So for the time being, the move in Apple does appear to be a bit of an overreaction. Could it lead to a more substantial repricing? Absolutely. But that's going to be kind of a situation we continue to monitor. But in addition to the fact that we've seen some of those characteristics be a little bit concerning or different from some of the other garden variety pullbacks that we've had in 2021, there are also several positive signs that continue to remain in favor of market longs of the bulls. And that includes positive rotation back into growth. That's something Terry has been all over in Optima via RRG. And in fact, yesterday, we actually saw yesterday's market low be met with positive tick divergence from yesterday's or last Thursday's extreme. So tick is one of the market internals that we utilize. And we also have an attempt to curl higher on the put call ratio. That's something we've been tracking with you. And in addition to the poor market breadth or lack of confirming highs, we've been in a very headline-driven and saturated market. Information is flowing in real time. Investors are left, scrambling to mostly react to price action. We had rather hot inflation data early in the summer. We just had NFP ADP misses. Yesterday, we had CPI data out coming in below analyst expectations, both the core and the headline. So in times like now, price action is your friend, and we believe that the collective mindset of market participants and the collective mindset of the market will manifest itself in pattern developments. And thus far, we've yet to see that collective shift in sentiment. Yet. Could it be here? Certainly. But thankfully, we feel the hard right edge of the chart will make it clear and make it known when and where to short this market, if in fact we are getting ready for that larger wave 2 pullback. Okay, so that's my opening spiel. Let's go ahead and bring in the trading analysis team. Good morning, Terry. Good morning, Alex. What's happening, gentlemen?
Good morning, gentlemen. Good morning, traders.
How are you guys today?
Hey, guys.
What's up, Alex?
Well, nothing much. We are observing this, in my country, relatively strong bounce in COVID cases, almost close to 8 to 10,000 a day, which is for a small country a lot. So we are going to go into some measures. So yeah, things are as usual. So
Hey, the past 18 months, 19 months or so have been very different. So hey, it's kind of par for the course. I hear you.
Yeah.
Terry, the storm dodge you? You make it out all right?
I'm just drying out a little bit. You know, where I live, the storm really came in further south on the coast of Texas, and it only turned into a Cat 1 storm right as it was making landfall. Houston, people in Houston, about 500,000 people initially lost power, and but the utility companies got about 70% of those people back online by say 5 o'clock in the evening.
Oh, good. That's not bad.
So we didn't have any problems. We just a little bit of rain here. The grass needed watering. So where I'm at, fortunately, we're all good here.
Good. Glad to hear that. All right, so let's hit it. We got started a little bit late. I'm going to take you guys through the charts, Motive Wave platform, and then we'll be back. We'll carry into sector focus, and then we'll have Alex in to discuss the macro scene. So, boys, I'll be back on the other side. See you in a few minutes. All right, good morning once again, and thank you guys for tuning in. We do appreciate it. So let's jump into it. Hard right edge of the Motive Wave platform. We're going to take a look, starting it out with price action this morning in the S&P 500. And the reason I want to start with the S&P 500 is it helps to illustrate the reason why I continue to remain constructive, even in light of the fact that the Nasdaq is pulling back from such a significant cluster of resistance. So in the S&P 500, going back to the COVID sell-off lows in March of 2020, when we complete this sharp directional C-wave correction, the rally that's followed has been a little bit choppy. The initial price action and structure off the lows has been indecisive, and as a result, there are multiple valid interpretations. And when I say valid interpretations, I mean based on the rules and guidelines of Elliott Wave, there are multiple valid counts. Thankfully, they all suggest more or less and imply the same movements. But given the fact that there are multiple valid interpretations, and add on top of that the fact that this year we've seen a lot of overlapping price action, we've continued to kind of disconnect ourselves from the higher degree situation. Certainly we're aware of the resistance of the higher degree structures, but we've been operating mostly based on pattern developments and relative rotation analysis. And what we've continued to see are directional 5-wave moves on the upside and the counter trend corrective pullbacks on the downside. We've yet to see that dynamic change. And as a result of the S&P's multiple counts, I've begun to shift our focus with our clients more so into the Nasdaq 100 in terms of analyzing the collective mindset of the market. Our last high conviction objective in the S&P 500 was up here at 43.85. This was the last high conviction Elliott Wave objective, Fibonacci objective that we were able to count from a more typical impulsive structure. You've got the rules, but you also have guidelines. So of those multiple valid interpretations, we can certainly narrow it down to ones that are of higher conviction. And that last higher conviction objective was 43.85. You can see if I just edit this guide really quickly, we'll take this up to 43.85, okay. 43.85 in the S&P 500 was met back in July. That was resistance, and it gave us about a 3.5% or so corrective pullback. You can see price action has since surpassed 43.85, and we've actually kind of back tested it here into the August low and turned it into support. So 43.85 in the S&P 500 was met. Let me take you over to the Nasdaq 100 and continue our discussion. In the Nasdaq 100, that same high conviction Fibonacci objective or resistance cluster for us was 15,500 to 15,700. And this includes degrees of trends that go back to before the credit crisis lows. So it's clearly longer term data, longer term structures, and they are to be respected. So that level for us of 15.5 to 15.7, you can see outlined up here in this green box. I'm going to take you off of the daily and take you down to the 1 hour chart. You can see price action, price action here between 15.5 and 15.7. As soon as the Nasdaq 100 met that zone, we started to hesitate. And last week we were looking at the idea that maybe this was just some sort of a sideways correction, but we were also aware of the fact that we could see a more significant retracement of this rally that unfolded between the August 19th lows and your September 7th highs. So 43.85 in the S&P, it's been met and it's been turned into support. 15.5 to 15.7 in the NDX, that same high degree conviction target, it is giving us resistance. But like the S&P 500 did to us back in July, we're not getting those confirming signals to suggest that, hey, that is your wave one. You're going to be now seeing a larger wave two pullback. Is it possible that this is the case? Absolutely, and we're aware of this possibility, but we feel there's no reason to act or react to the current price action when number one, we anticipated the pullback, and number two, we've yet to see a clear change in market sentiment. So while I would love for this to be orange primary degree wave one, setting us up for a more significant pullback, just kind of a broad-based market reset, I don't have the confirming signs yet to say that we're there. Let me now take you down to the smaller time frames and illustrate what I'll be looking for with our clients to determine if that larger move is here. We're actually going to use the S&P 500 to illustrate this point. And what I'll do here is I'll take you off of the daily chart. We'll drop the yellow circle in the upper right-hand corner of the chart just so you can get some context as we drop to the smaller time frame. Down to the 195-minute half-day chart. We use 195 versus 240 as you get exactly 2 bars for one trading session. We'll go even 195. I'm going to go 1 hour, and then I'm going to take you down to the 15-minute chart. We're going to have to zoom back out a little bit, adjust scale. We can delete that circle. All right, let's talk about what we've had here in the S&P. In the S&P 500, from the August 18th low up into your early September highs, all we have evidence of thus far is a 3-wave decline. This 3-wave decline we're counting as down in a sharp 78.6% retracement in B, and I just hit the wrong keystroke. Let me fix that. A 61 to 78% retracement in B. And then I want you to look at this subdivision of the decline from orange B. Look at the amount of overlap that we see in this structure. There's clear indecision at work here in the market. This is not a decisive trend to the downside. Could it turn into one? Certainly, but we don't have that evidence yet. So we now have 3 waves to the downside. Inside of the C wave, we need to count a 5-wave structure. Zooming in here, going into yesterday, we had identified blue wave 4 resistance up to 44.81. We got a 44.85 high. So we were looking for 44.81 resistance with our clients and expecting this new low. So now that we have this new low, we've met about a 61% retracement of your August 18th through September 1st or 2nd rally. And we could see another low this morning. I won't discount that possibility. If we take a look at your wave 5 projection zones, we could go down to 44.20s. Wouldn't be out of the question. So this is where things get different. Based on, and let me clean this chart up I'll just clear all my ratios. And now we can go back to 15-minute chart. So with 3 waves off of the top, we now have a completed or potentially completed corrective structure. We would then need to see this move higher in 5 waves, counter trend correct in 3, and then see another continuation move in a second actionary wave on the upside. If we see that second actionary wave move break through 44.93, I'm going to be immediately looking to position for a move back to the highs. But if our 15.5 to 15.7 cluster in the NDX is all she wrote for 2021, and we are getting ready for that orange primary degree wave 2, this is what we expect to actually unfold. Instead of starting a move back in an impulsive trend, we would be looking for a wave 4, which would pair up to this pullback that ended on September 9th. And if we get a counter trend move into 44.65 up to 44.79 resistance, and that breaks into a new low, we will then have a completed 5-wave structure that's going to be wave 1, or at least an A wave, and we'll be then looking to short the B or wave 2 with our clients. So that's it. Let Elliott Wave be your guide. There's no point in reacting. There's no point in repositioning. I'm not touching my longer term investment accounts until I have a clear change in market sentiment indicated on the chart. And we don't have it yet. So far, garden variety corrective pullback, a lot of overlap, and yet to see the confirming signs from market internals or market rotations. Okay, that's it. I know I took a lot of time. Let's go ahead and jump back over to the team. We do appreciate you guys tuning in. All right, gentlemen. So what do you think?
Good job. Good job, Bennett. Yeah, as you're going to see here in a moment, I'll show you my RRG stuff. Markets are still holding above the 50-day moving average too. So, you know, garden variety decline, maybe, maybe not. But if we were to go back and look at about the magnitude of the prior declines that we've had, we have not exceeded that yet. So,
yep.
So yeah, we just we keep our I don't know how you say it, keep our powder dry and ready to pull the trigger whenever we do get that confirming signal. But you know, guys, there's no need to jump out early, bail out early, and mix. Man, I can't even talk this morning. Let me get some coffee.
It happens. And to Terry's point, you know, that pullback that we've seen now to nearly the 50-day moving average has been met with 6 or so consecutive distribution days, and that is a little bit different from what we've seen out of the last four or five pullbacks. So we'll see what happens.
Yeah.
All right.
Yeah.
Ready to? Yeah. Go ahead.
From that perspective, Elliott is really a very handy tool because it'll tell you.
Yep.
You see your sideways down and a pullback. I mean, there is probability will increase. We're going to go down, and then you track it. If you see this develops in a further larger degree of move, you know where you are. So from that
absolutely,
until we see that, there is no point of making any unnecessary panic.
Yep, very well said. Very well said. All right, let's jump into sector focus, and we'll be back on the other side. Ready to go, Terry? All right, here we go.
Yes, sir. Hello, traders. I'm Terry Long with TradingAnalysis.com and your weekly sector focus. Last week was a shortened trading week following the Labor Day holiday, which ended up with the markets consolidating throughout the week. And markets this week are continuing to behave in a bit of a muted fashion. The S&P pulled back from setting an all-time high that it did the prior week. Friday's drop was the largest decline of the week, and we did close right below that 20-day simple moving average you can see here. And the market was down 1.69%. I don't have my label on there. I forgot to put that there. But last week, S&P was down 1.69%. And the NDX also declined throughout the shortened trading week. It fell 1.36%, so somewhat less than the S&P. But here on Friday, the NDX did hold a close above its 20-day moving average. Last week's market decline was very broad-based, with all 11 sectors in decline. Now, real estate sector fell the most, declining 3.23%, followed by healthcare, industrials, technology, and energy. And the best performing sector was consumer discretionary sector. It declined only 0.34% last week. Now, if we take a look at price action for this week, let's get this out of the way there. You can see that the action in most of the sectors is still fairly muted. The energy sector is having a larger bounce, I think mostly due to its deep lagging condition already. And although the S&P closed on slightly higher on Monday, Tuesday's pullback now has the S&P down 0.35% on the week. The NDX is down 0.37 for the week. And let's take a look here. Right behind there is my little table that shows what's going on in the market here. So this is real time. The materials and industrial sectors are down. They're the week's worst performing sectors so far, down about 1%. Move over here into our excuse me, weekly rotation. 4 of the 11 sectors still remain in an outperforming condition relative to the benchmark S&P. Now, when we see such a broad-based market decline, I really don't expect to see any major shift in the weekly relative rotation chart. And remember, this chart plots each sector relative to the benchmark S&P. And since all of the 11 sectors are components of this benchmark, it stands to reason collectively for there to be very little noticeable change when we do get a big move like we did. Now, although the real estate sector fell 3.23% last week, that was coming off a 4% gain the prior week. Real estate, technology, healthcare, and communication, they still remain strongest sectors in terms of relative strength. That's this x-axis here. However, real estate and communications are currently experiencing lower momentum. That's why they're below the horizon line here. Lower momentum than the benchmark S&P. Down here in the lagging quadrant, financials and industrials are seen with some rising momentum, but they have yet to turn back eastward. Therefore, they are still weakening in terms of relative strength. And the energy sector continues to push deeper west down into this lagging quadrant. It has started a little bit of a northerly turn to try to recapture some momentum, and you can see that with the gains that we've seen so far on Monday and Tuesdays. Now, I mentioned this as materials sector earlier, but I think it's the industrial sector that isn't exhibiting a similar rise that we are seeing in the materials and the financial sector. So I do expect to see, excuse me, I do expect to see some further weakness there. Now, in the M quadrant, the utility sector continuing to rise with a strong northeasterly heading. So the vector does appear to be slowing down just a little bit here. Consumer discretionary and staples sectors, their tails are fairly short, and so they're fairly stationary where they're at. Very little change in either momentum or relative strength in these sectors. Slight gains in staples, slight decline here in the utilities. I will make note that if we take a look here, the technology sector has recaptured first place in terms of our relative strength ranking, as we see real estate just continue to move to the left a little bit here. We're only seeing a decline in momentum of the technology sector and a little bit of decline in momentum here in the healthcare. But this westerly movement means further weakening in the real estate sector is possible. Notable though, even though the vector is very short here in communications, it is a very positive signal for the communications sector that the arrows, that the rotation you can see is turning back clockwise, which indicates that, to me, that the communications sector is very hesitant to continue to decay further over. We'll take a look at a couple of the charts here real quick of these sectors. And the XLK slid mostly last Friday, closing down just below its 20. And you can see that green line right there is a 20-day moving average. The blue is the 50. So we're still well above that. And this is what I was talking about, that the size of the corrective move that we've seen here compared to past corrective moves is not even in the magnitude of what we saw back in May, right? So it's still a very shallow correction. Here's another corrective move that we had back in July, and you can see relative sizes of these means it's very possible we have a further continuation to go to the upside here. Now, in technology, the weekly relative rotation chart of the top 30 by market cap shows a large proportion of stocks. Let's sort this by relative strength ratio. Almost 50% of the stocks in this group have a relative strength greater than 100, meaning that they're outperforming the benchmark. But the key thing is several of the ones that are actually with relative strength lower, if you look at the direction of the arrows, the vectors are all headed in the northeasterly direction, which means that these stocks are rising in momentum and relative strength simultaneously when we have these northeasterly headings. Several of these vectors are blue, which indicates that they have a improving weekly trend. So I'm looking at this as a weekly relative rotation chart. A lot of the price charts I look at are daily, but these signals depend upon the time frame that you're analyzing. So on weekly charts, we're not talking day trading, right? So day traders don't pay attention to this. You need to drop down into smaller time frames. But if you're investing and you're looking at where your money needs to go, here's a couple of opportunities here. KLA Corp, Broadcom Corp. Actually, I think I've shared this with Bennett. If not, I'll do it right now. Broadcom has been in a long trading range consolidation ever since back here in February. Just chop, 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 chop. Finally, I noticed here on August 30th that we actually broke out of that trading range, that historical range right there with a new high pushing up. And now I think what we've got here is this past high is going to become a new support level. So here's a technology stock that looks to me like it's on its legs, ready to start to run again. There are several opportunities. So take advantage of the fact that the market is in a decline. That's the time for you to be looking for those stocks that are outperforming the rest of the market while the broader market declines, right? So stocks that are outperforming, look one here. KLAC just set a new all-time high. Following this triangulation, we're getting back up all the way back to this all-time high. We did see a fairly sizable corrective move here, but that corrective move did not take you back into the zone of the triangle. Therefore, I believe possibly we've got more upside going here. Let's drop that back out of the way. I want to take a look, since I mentioned communications, let's look and see what's going on in the XLC. I think the uptrend is still intact. Now, the XLC did pull back down here to its 20-day moving average, and you can see there's the size of the corrective move so far. And it's relatively in line with several of these past corrective moves, and not necessarily as large as the one that happened back in May just yet. So if this is the first leg of a larger corrective move, we'll see that play out. We're going to get we'll get a head fake move back to the upside and a failed breakout of the all-time high. But for now, we're still running above the 50-day moving average, hanging into the 20. This is a buy zone. So there are opportunities on board here. Several stocks are this week: Interpublic Group, Live Nation, Google, Omnicron, AT&T. They're all posting positive gains so far this week. And here's a relative rotation of the communication sector. Now, doesn't look quite as good as the technology sector does, but there are still several of these beaten down stocks that I mentioned starting to move and get that initial thrust back up to the north. But at the same time, there are a few, such as Twitter, that are declining dramatically here. Twitter and Roku, both of those had pushed up here into the leading quadrant and rapidly lost momentum. Let's take a look at Roku. I know Bennett has certainly got a wave count on Roku. And it's not looking constructive, because what I was hoping that this low here was going to be anchored as a support for a new uptrend. The price action breaking below that, you can see here the 20 crossed below the 50. The 50 is about to cross below the 200. This is not a constructive look for Roku. I think what happens in Roku is we just have a much larger corrective move in play here, probably, that takes us back down either to this 295 support level, or maybe even a little lower, before Roku gathers itself, but certainly we can see that. We can see evidence of that happened, that the momentum shift and the rapid decline, the length of the tail compared to the other stocks, that one's not the one to be in. Netflix, however, Netflix has got a blue weekly improving trend. Netflix came out of a triangulation, broke cleanly above that, set a new all-time high, and is taking a bit of a corrective move right now. We'll see where this ends, but this could be 5 up. We get 3 back. We get a good clean signal. We can go long in Netflix here in the near term. So, Bennett, I'm going to leave it there and hand it back to you.
Much appreciated. Thank you so much. Excellent work as always. I want to quickly cover this question before we carry on. Let me pull up our team analysis so we can all stay in the call. Yeah, this will work. Okay. So last week the question was regarding the multiple counts in the S&P 500, and last week what we had identified here in the Nasdaq specifically was the fact that we had completed 5 waves up. At the time, we were looking at September 1st as the possible anchoring of that wave 1. And we had a move down at the time we were counting as an A wave. We had 3 waves up in B, and we had proposed a C wave decline right here, looking for a zone of support. Now, what ended up happening is this larger correction set in, and that was a possibility that we were aware of due to the fact that if this is a wave 2, wave 2s can take you to a huge variety of retracement levels, anywhere from a 38% down to a 78.6%. Now that we have this correction, however, given the fact that we only have evidence of a counter trend move to the downside, there's no point in looking at that as the wave 1 top. And in regards to the multiple subdivisions in the S&P, I'm assuming you might be referring to perhaps the subdivisions from the September lows. There are multiple valid counts. And what we had last week here in the S&P was we had a move down in A, 3 waves back in B, and we were looking for this decline to find support at potentially a 1272 external retracement of this rally up into September 2nd. When that didn't hold, we had we saw this larger correction set in. It's a wave 2. Wave 2s are very tricky, which is why you're best to await a completed corrective structure. I hope that addresses the question, and I do apologize for responding under Todd's account, but due to the fact I'm logged in running the show, it was the only way I could respond. So, all right, Alex, you ready to bring us up to speed? I see Kathy Woods reiterating her $500,000 Bitcoin target, huh? My goodness.
She didn't say when, though.
No, she didn't. She didn't. And she's a long-term investor, that's for sure. But I love her boldness at times.
Hey, we've had, Alex and I, we've had $500,000 show up on our fib ratios before too.
Oh, for sure.
We just don't say.
I remember pre-split in Tesla when she threw out that $4,000 target. We were looking at some fib objectives that would support it, and it's like, well, maybe she's not crazy. So anyway.
Yeah.
Just reading this question really quick. Yeah, Ralph, you know what? I'm actually going to put out a public video on our Trading Analysis YouTube channel later on today. I'll talk a little bit more in detail about the subdivision possibilities of a wave 2 and some of the signs that you can look for as a trader to help identify the fact that that low is not holding. So last week, looking at that C wave decline and the potential 1272 support, I'll show you the signs we look for and the response we expect off of it to say, okay, that's the low. It's time to sound the all clear on the upside. So look for that on our Trading Analysis YouTube channel, youtube.com/trading analysis this afternoon. Alex, let's hit it. You ready to rock?
Sure.
All
Let's
right,
go.
here we go.
Hey guys, so as usual, let's look US government bonds 10-year yields. This is one of the charts, as we know, which is mostly look for the inflation deflationary scenarios, and we talked about this a little bit more last time, so I don't want to spend much of a time because really nothing changed. we are flipping back and forth between a possibility we stage one more move on the upside towards this tube when we will have some type of an ABC or a more impulsive development on the upside, and in the case we break this 1.28 on the downside, having this as a small corrective pullback in a lesser degree wave 4, we will be looking relatively lower in the months to come, because then this will be most likely a complex corrective pullback, which we usually label as WXY. All of these legs in this complex corrective pullbacks has 3 legs in it. So this will be an ABC on the upside, ABC on the downside, X wave in 90, I will say 90 or to 92% of time test this B wave of the previous corrective move in any way on the upside or on the downside, depends from where the price action is coming, and then you will have another 3-wave move. So if this scenario unfolds, we're going to have a couple of years sideways back and forth in rates, which maybe kind of corresponds to the possible deflationary, inflationary roller coaster that we might see with bottlenecks, with possible now COVID closures for a month or two, or even a couple of months, and then reopening again. So same old story is kind of repeating again. We had yesterday some of the CPI data month to month, and we came a little bit below. Core CPI was at 0.1, forecasted was 0.3, and CPI was at 0.4. It came at 0.3. As you can see today, we had some CPI data year on year and month on month in UK and in Canada. They came a little bit higher. In Great Britain or UK was at forecasted 2.9. It came to 3.2 and 0.2 in Canada, which is month on month, not some significant increase. So for now, as people are still discussing regarding inflationary to be transitory or not, we are seeing the 10-year yields are still capped in this kind of a small, really very small movement from the FP. Fed meeting is next week on 1st. So that will, I think, give much more clarity what we'll do. Have also heard that they're going to start tapering in October. I guess we will be keen to from Jerome Powell next week, and until then we will continue to follow this probable path, which might be pretty much in a 5 waves down. So we will see until we break this support levels. In Europe, situation is tracked with the price of the German Bund. This is the 10-year Bund price. It's not the yields because of the clarity of the wave count. Still a consolidation. We hit this resistance of the channel from the upper side. As you can see, it acted as a nice resistance, and then we are backing down, and probably we're going to stay in some type of a triangle, which means that we're going to back and forth like in US yields, and then finally we're going to embark on another deflationary wave on the upside, which might take its course even in a year or year and a half until these triangles or sideways consolidations actually fulfill their patterns. Okay, so I'm gonna keep tracking this. As you can see, yields are not moving that fast as the other assets classes, so we have to be patient and observe what is going on. And for now, it's pretty much doing the same beat for the last year and a half. From that, we're going to jump to US dollar. As you know, we track closely dollar index for our members, and dollar index is still in a potential B wave lows. We still didn't get a final confirmation of the C wave. We see on a small time frame something which resembles a 5-wave move, but it still need to see a further move on the upside. So what I want to see here is actually after this low, which we consider this as a truncated 5th wave, we want to see a continuation in a clear 5 waves, small pullback where this support this resistance will act as a support now, and then a continuation on the upside. I'm gonna stay bullish on the US dollar towards the end of the year, at least November, December, as long as I have some of these key levels or key zones, as long as we hold these key zones. And for now, all of this is behaving according to the Elliott Wave script. Support levels are at 91. 64, and the first resistance comes as this previous highs at 93.50 in this case. In regards of some other asset classes, we have seen also some of the, and we mentioned that regularly for our members, we are tracking a little bit of course, copper, still in a sideways price movement. So we are still kind of moving into 3 waves everywhere, so this might turn relatively complex. The resistance is at 4.62, and we are tracking also this as a potential complex wave with a little bit more of a downside, as the dollar might at some point progress on the upside, and of course they are correlated on that respect. We have also this correction in soybean early development. It should a little bit some fib levels that we usually have with this bottleneck supply, but then we look this as a 4th wave, and we are coming soon to completion of this, a little bit more complex, but we expect also in this one in one moment after dollar finish its dance, a further move on the upside. So let's stay on these commodities and let's look a little bit what's going on in metals. We usually track gold, and we talked about gold also last time. Not much of a change. I see some type of a 5 waves up on a smaller time frame. This is a wave A, up in B, down in C. So I will expect a little bit more downside towards this 1,600 and 760, 740, and then potentially one more move on the upside in this possible D wave. This is just my hypothesis that we are in a triangle. We can be also in the WX or a triangle XY and go lower. So I don't know in this moment. This is just a kind of a handy wave count because we have held this 1,670 pretty successfully so far. So I choose for now, maybe the triangle will be my kind of a primary wave count just because of these facts, but in reality, I am prepared even to see lower prices. On gold, silver is pretty much the same, doesn't move much.
Alex, I'm just going to jump in here and tell you that I gold, I think I'm probably a little more bearish than you are, because I'm starting to think in the downtrend. We had last week, I think we were in a crossroads where I was showing my members. I didn't show today, but we failed to break above that prior high a couple weeks ago after the dip, and that rejection. I'm looking at futures this morning on gold are all over the place. There's a lot of uncertainty happening there in the gold market. I saw gold drop from just this morning from 1805 or 7 or something all the way down to 1797, and then back. It's starting to move back up again. So I don't know. In the shorter term, yeah, this one, it's more likely that this wave count you've got right here is what I see. It just continues in this downward trend channel. There's just to me, there's no clear evidence that we're out of it yet. The only thing that gives me pause on that is the sharp rejection that we saw there at that 1680 level back in September. That was a very sharp recovery bounce signal, but
Yeah.
that bounce took us back up to that 1830 level and then stalled out, and now it's okay, it's over. So maybe more weakness ahead. Anyway, that's my perspective on gold, but we can certainly continue the triangle discussion. But for now, no clear upside action.
Yeah, I agree completely with you. I mean, we have very well defined this, at least support level is very visible. So in that respect, this support level, which had held, as you well put last time, it is going to be key level. If we break it, we definitely gonna continue on the downside. So nevertheless, even
we got
if we
more
go
downside, keep an eye on that level for sure. Exactly.
Yeah, for sure. Yeah, so silver is pretty much in the same situation, as you can see. So we are going forward trade one trading. So this is a daily chart. It's a huge amount that you trade in a sideway. From one side, that's good because any breaks, especially on the upside, will actually usually provoke a very big advance. And we are fluctuating from 2150 to 29 back and forth. So I'm still going to keep this potential flat, or also triangle is possible here. But as long as we don't exhibit anything kind of a five-ish on the upside and a pullback, so this all of price movement are in a three waves. We are going to look for just silver as something which has a potential, but not recommending any kind of a position on it, at least yet. That's from my perspective. So let's move, especially if you have a dollar a little bit bullish. So Bitcoin is still also in a very kind of a clear situation, at least shorter term. Longer term, we are bullish on a Bitcoin, but just we are looking how this correction will unfold. Are we going to see a move back down to this and test this channel, or are we going to see a triangle or immediate upside? So you really can go back and forth for every of these wave counts. One thing, what I'm looking short term, I see a possibility we test this 39, 40, 39, 37, 4K levels, 40K levels. So we are dancing around this 200 moving average, and we are moving up. So I'm looking some of the levels there, and probably I'm going to position myself to see a further downside. On the Bitcoin, we failed to move above this 786, which is for us a crucial confirmation that potential higher 127 or even higher third wave has started. So that fact is kind of makes me on the toes regarding this bullish 100,000 calls in a 15 days. Longer term, 500K. It's possible. I mean, we have the wave count, which has that target around 520Ks. But I mean, she's a really longer term manager of this innovation stuff. So she's looking 10 to 15 years. And what they look in the predictions is actually the network effects, because basically Bitcoin as a current store of value, still it's in my opinion, it's still not differentiated what the purpose is going to serve in the future. Are they going to treat it as a limited supply, kind of a digital gold, or some type of a currency? So this is left to be seen. So many other very cool projects are coming into cryptos. Crypto space is developing. We are going to stay bullish, but just to wait a little bit how this will unfold in order to recognize the pattern and ourselves accordingly. If you want to hear those tomorrow on the
Thank you, Alex. It looks like we're getting a little bit of packet loss there at the end from your audio, but excellent work there. And if you guys are interested in more cryptocurrency specific coverage, you can check us out tomorrow morning at 9 a.m. for Crypto Lab on the Trading Analysis YouTube channel, youtube.com/trading analysis. Markets are open. We saw the S&P move just a little bit lower, keeping our eyes on the internals here. Members, we'll see you in about 15-16 minutes for the member webinar. And if you did enjoy the content, we would ask that you subscribe with notifications, give it a thumbs up, let the YouTube algorithm know that you are enjoying the content. And hey, we've got a lot more coming up on the Trading Analysis YouTube channel. As I mentioned last week, we'll probably be moving this show there in the near future. So just keep that in mind. Gentlemen, team, excellent work. We'll see you guys same time, same place next week. Any final words of wisdom?
hit the like button, guys.
Hey, look at that nice little rally we got trying to stage over there at the trading desk. Got to get back to it. So, hey, thank you guys. We do appreciate you taking time out of your Wednesday morning to join us and be here for the TA show. So, have a good one, and we'll be back. Have a good one, guys. Take care.
See you. Bye-bye.